All right, let's talk about investing. When we're looking to put our money somewhere, that word safe is usually at the top of the list. So today we're diving deep into three of the absolute safest government-backed options here in India: fixed deposits, RBI bonds, and the very popular sovereign gold bonds. But here's the thing, safe isn't enough anymore. We're going to figure out how to build a smart strategy for them, looking specifically ahead to 2026.
And that really brings us to the big question, doesn't it? It's one thing to know your money is safe, tucked away somewhere, but is it actually working for you? Is it growing? Is it smart? In today's world, are you sure you're picking the right tool for the job? Well, let's find out.
So let's start with the one we all know, the OG of safe investing, the fixed deposit, or FD. Think of this as our baseline, our safety benchmark that we'll compare everything else against.
The best thing about an FD is just how simple it is. It's a three-step dance. You put your money in, you agree to leave it there for a fixed amount of time, and when that time is up, you get your original cash back plus a guaranteed chunk of interest. No surprises, no drama. It's wonderfully predictable.
So, what does this all really boil down to? One word: control. From day one, you know exactly what return you're going to get, thanks to that fixed rate. And the flexibility? It's fantastic. You can lock your money up for just 7 days or go for a full decade. Plus, with a super low entry point, it's pretty much the most accessible investment tool out there for everyone.
So when should you actually use an FD? Well, think of it as a specialist tool for specific jobs. It's perfect for that emergency fund that you absolutely cannot risk and might need at a moment's notice. It's also ideal for a short-term goal, like saving for a down payment in 2 years. And of course, it's tailor-made for anyone whose number one priority is protecting their capital, no matter what.
But, and you knew there was a but coming, here's the trade-off. What's the catch? For all its safety, the interest you earn is fully taxable, based on your income slab. And this is the big one. In a lot of cases, after you pay those taxes, your return might not even beat inflation. That means your safe money is actually losing its purchasing power over time. And that is exactly why we need to look at other options.
Okay, so let's move on to our first alternative. This is an instrument designed specifically to fight back against those sleepy returns, the RBI floating rate bond. This is where we start getting a little smarter with our portfolio.
Now, unlike an FD, the interest rate here isn't locked in, it floats. See, the rate is linked to another government scheme, the National Savings Certificate, and then the RBI sweetens the deal by adding a guaranteed 0.35% on top of that. So what does that mean for you? It means that as interest rates go up in the economy, your return goes up too. It's designed to adapt, which is pretty clever.
Now, there are some pretty firm rules with this one. It's a 7-year commitment with a strict lock-in. You get your interest paid out like clockwork twice a year, but you can't just sell the bond to somebody else. It's a non-transferable investment designed just for resident Indians.
However, and this is a fantastic feature, there's a special perk for older investors. The RBI built in something called stepped liquidity for senior citizens. Basically, the older you are, the shorter the lock-in period becomes, which offers some much-needed flexibility when you're planning for retirement. All right, time for our third and final contender. And this one is a real game changer. Let's talk about sovereign gold bonds, or SGBs. This is the government's modern, digital answer to investing in gold. The absolute genius of the SGB is what I like to call its dual-engine return. Think about it. Engine number one, you get a fixed 2.5% interest every single year, just for holding it. Engine number two, you get all the capital appreciation. If the price of gold skyrockets, you get all of that upside. You are literally getting paid to hold gold.
But listen, this is a long-term play. The full SGB life cycle is 8 years. For the first 5 of those years, your money is locked in, though you'll still get your interest payments. Then, starting from year 5, an early exit window opens up, before the whole thing matures at the end of year 8.
Okay, so everything we've talked about so far has been pretty standard stuff. But for 2026, the story takes a very, very sharp turn. We have to talk about the huge plot twist that every single SGB investor needs to know about, what I'm calling the 2026 SGB tax trap.
So what's going on here? Why now? Well, it's a perfect storm of 2 major things. First, Budget 2026 changed the rules and restricted who gets that amazing tax exemption. And second, there's a supply crunch. With 0 new SGBs being announced for this fiscal year, investors have to go buy them from other people on the secondary market.
And this right here is where it gets absolutely critical. Your final tax bill now depends entirely on one simple thing: how you got that SGB. If you were the original subscriber, you bought it directly from the RBI and you hold it for all 8 years, your capital gains are 100% tax-free. But, and this is the trap, if you bought that exact same bond from another investor on the stock market, that exemption is gone. Poof.
Let's just be crystal clear about this so there's no confusion. The big takeaway is this: SGBs that you buy on the secondary market have lost their single greatest superpower, those tax-free capital gains. And that fundamentally changes how you should think about them and how much you should pay for them.
Okay, we've met our 3 contenders. We know their strengths, their weaknesses, and their secrets. Now it's time for the final showdown. Let's put the fixed deposit, the RBI bond, and the sovereign gold bond side by side and see how they really stack up against each other.
This table really lays it all out, doesn't it? You can see the trade-offs so clearly. The FD gives you amazing flexibility and liquidity, but you pay for it in taxes. The RBI bond protects you from changing interest rates, but you've got to be in it for the long haul. And the SGB, it offers that incredible tax-free growth, but only if you're the original buyer who can commit for the full 8 years. Each one has a clear purpose.
Now, knowing all these differences is one thing, but how do you actually use this information? Let's get to the most important part: building your personal sovereign investment strategy.
Look, your strategy really just comes down to matching the right tool to the right financial job. It's that simple. For your emergency fund, you need the high liquidity of a fixed deposit, no question. For stable, regular income that keeps up with inflation, the RBI floating rate bond is the clear winner. And for that long-term, tax-free wealth creation, nothing beats an SGB that you bought directly from the source.
And specifically for SGBs, with this new 2026 tax trap, here is your 3-step game plan. First, be brutally honest with yourself. Can you really, truly lock up this money for 8 full years? Second, if you want that tax superpower, you have to prioritize subscribing to brand new tranches whenever the RBI announces them. And third, if you absolutely have to buy on the secondary market, you need to do the math and discount the price you're willing to pay because you're going to have to pay capital gains tax later.
So there you have it. That's the complete guide. The pros, the cons, the strategies, and the traps for India's top government-backed investments. The playbook is officially in your hands now. So the only question left is, which one of these powerful tools are you going to use to make your money work smarter?